Hey, good afternoon. My name is Lazari Caston, and I'm assisted by Alexis Barini, Precious Hamilton, and Reginald Pettis. And I'm doing a brief overview over Occidental Petroleum. Occidental Petroleum is a pivotal movement where global energy demands, climate policy, and also capital discipline converging within the industry. To help secure like a long-term competitiveness within the leadership, the energy transitions over a 5-year transition or strategic plan that targets, of course, two core priorities. The priorities are investing in low carbon chemical innovation through OxyChem and also enhancing upstream efficiencies through AI powered automation. These are backed by strong return on equity, resulting in 48.2%, and return on assets 4.66%. These dual initiatives will expand margins, drive sustainability, growth, and future OXY operations against regulatory and market shifts.
Good evening, everyone. Our first recommendation for Oxy is to expand into low carbon chemical innovation. This aligns with the company ESG goals and long term profitability strategy. The goal is to transition OxyChem's product lines toward environmentally sustainable and carbon neutral processes. Specifically, we propose three focus areas: low carbon PVC using renewable or carbon neutral ethylene and chlorine processes. Number two, green hydrogen integrating electrolysis powered by renewables to replace fossil fuel derived hydrogen. From number three, bio-based feedstocks, leveraging cellulose-based raw materials to improve biodegradability and reduce product carbon footprints. This not only supports regulatory compliance, but also enhances brand positioning as ESG's expectations tighten globally. Strategically, this move leverages OxyChem's position as a stable revenue source, especially during oil price downturns. Thanks to its non-cyclical cash flows, financially expanding this ESG's aligned products could enhance margins, particularly as Oxy's current operating margins sit at 16.3%. Specialty chemical products like low carbon PVCs have potential to uplift consolidated profitability. Additionally, we leverage Oxy's return of assets at 4.66% and return of equity at 48.02%, which reflects strong asset productivity and capital efficiency. This supports high return investment into innovative product lines. Oxy's return on assets of 4.66 means the company generates about $4.66 in net income for every $1 in assets. While modest, this reflects steady profitability in capital-intensive industry. The return of equity of 48% is significantly higher than the industry norm. This indicates efficient capital use, but we also note the potential impact of leverage. It's crucial to sustain this ROE responsibly by investing in high-margin, low-volatility projects like green chemicals. Maintaining this high ROE while enhancing asset efficiency could boost investor confidence and valuation multiples. This positions Oxy's well to drive innovation, improve environmental impact, and capitalize on strong financial fundamentals.
I am Alexis Barini, and I'll be presenting our second strategic recommendation, a partnership driven approach to improve upstream efficiency through AI automation. We propose that Oxy form a strategic partnership with a technology company such as Schlumberger or Halliburton Digital Solutions. The goal is to implement AI-driven automation at select oil fields with the target of achieving a 10 to 15% reduction in unit operating costs over the next 2 years. This strategy focuses on three key areas: real-time performance monitoring, using sensors and cloud platforms to track well operations continuously and detect issues immediately; automated production optimization, using AI to adjust injection rates, flows, and pressures for better field output; and predictive maintenance, leveraging machine learning to anticipate equipment failures before they occur, reducing unplanned downtime. By partnering with firms that specialize in upstream automation, Oxy gains access to advanced digital tools without having to develop all the necessary systems and infrastructure in-house. We recommend starting with the recently acquired Crown Rock assets, which are ideal for tech integration, as well as older high cost wells where efficiency improvements can deliver the greatest ROI. This recommendation lays the groundwork for stronger operating margins and long term operational resilience. In 2024, Oxy generated 26.8 million in revenue and 4.38 million in operating income, resulting in an operating margin of 16.31%. This means Oxy keeps 16 cents in profit for every dollar of sales after paying for operating costs, but before interest and taxes. While this may appear like a solid margin, top performing oil producers often exceed 20% margins during strong market conditions. Compared to that benchmark, Oxy is underperforming, which indicates inefficiencies in cost management or asset performance. The fact that margins were higher in previous years suggests that rising costs or weaker field performance may be driving the decline. This is particularly important for a company like Oxy that operates in a highly capital intensive industry. The operating margin is a key indicator of how efficiently the company converts revenue into profits. If that number is falling while production remains steady, it means that more dollars are being lost. That's why lowering unit level cost is critical. We don't need to drill more or expand the asset base. We need to extract more value from the existing operations. This sets the stage for our recommendation, which is focused on deploying AI-based automation to cut waste, streamline production, and raise overall efficiency, ultimately pushing Oxy's margins closer to the 20% mark and improving competitiveness. With that margin gap in mind, this recommendation offers a clear path to improvement. A 10 to 15% reduction in unit operating costs would significantly raise Oxy's operating margin, moving it closer to the 20% benchmark we see among industry leaders. And that improvement comes without needing to increase production, just by becoming more efficient. Beyond margin improvement, this initiative strengthens asset utilization. By focusing on underperforming wells, Oxy can generate more output from its existing asset base, improving its return on assets, which currently stands at 4.66%. It also supports long-term return on equity sustainability. At 4.02%, Oxy's ROE is impressive, but maintaining that requires high return, capital efficient investments. This recommendation checks that box, delivering financial value while minimizing risk. Overall, it's a strategic way to boost margins, optimize performance, and strengthen Oxy's bottom line.
Hello, my name is Reginald, and I will be presenting the 5-year strategic plan for Oxy. So, over the next 5 years, Oxy is taking a two-pronged approach to stay ahead. First, we're investing in cleaner, low-carbon products through OxyChem. And second, we're making our oil operations smarter and more efficient using AI-powered automation. So, year one is the foundation. Year one, we kick off research and development in 3 areas: low carbon PVC, green hydrogen, and biodegradable materials. On the upstream side, we launch a tech partnership, either with Schlumberger or Halliburton, to pilot AI tools in our high-cost fields. Then that moves on to year two, 2026, we have our early results. By year two, we're running pilot projects. Automation starts reducing unit costs by 5 to 8%, and we begin offloading underperforming assets to free up capital for higher return opportunities. So an underperforming asset would be maybe like a field or a facility with high costs, low production, or high regulatory risks. We would offload those assets. Then that moves on to year three, 2027, where we're scaling up. This is when the momentum builds. Low carbon PVC hits commercial production, green hydrogen scales, and half of our U.S. oil fields start operating with AI-driven systems. That pushes our margins closer to 19%. Year 4, 2028, this is the moment we've all been waiting for: monetization. In year 4, we start monetizing these innovations, especially through carbon credits tied to our clean tech projects. At the same time, our ESG product lines go full scale. ESG is environmental, social, and governance. So those product lines will increase and blow up and go full scale. Then that moves us to finally year 5, 2029, our position of strength. By year 5, OxyChem becomes a leader in low carbon materials. Our oil operations run leaner and profitably, even if energy markets stay unpredictable. This entire strategy builds on our strong ROA and ROE and sets us up for long-term ESG-aligned growth. So when you zoom out, this plan isn't just about R&D, automation. It's about preparing Oxy to lead in a world that's demanding cleaner and smarter and more resilient energy solutions. So that concludes our 5-year strategic plan. I'm going to pass over to Lazaric to close this out. Thank you.
And to conclude this presentation, OxyChem's pivot towards sustainability and sustainable chemicals are paired with AI automation and upstream oil fields, marking a powerful balanced approach to growth by helping, of course, spread their market. These initiatives respond to rising ESG expectations while enhancing operational efficiencies and capital return over the industry and over the years. By year 5, Oxy will be a leaner, more innovative company by basically just having the simple features of leading capabilities in low carbon PVC and green hydrogen, streamlined oil operations with 50% automation, margins exceeding 20%, and that's huge in their industry, and a growing portfolio of ESG compliant high margin products. This strategy set alone sets Oxy up for great success and to lead the energy sector with resilience, responsibility, and also profitability over just the course of the time when they launched this innovative initiative.